Hello, Bill? Bill?
Hello?
Hi, can you hear me?
Yes, I can hear you.
Okay, it's Nadia. I don't see you, but I can hear you.
Let's see.
Hold
What-
on. You should click the participant view
Are
data.
you supposed, are you, the audience is not supposed to see me, right?
Uh,
Because,
no,
I,
I
I,
don't think so. It's just the screens. Hold on a
yeah,
second. Click on.
I didn't do hair and makeup, so,
Yeah, it's okay. That's okay. Click on the participants tab and you'll see once you see him, click on his name. Okay, move him to panelist. I have to move you to a panelist. So hold on a second. Promote to panelist.
join as panelists. Click.
Yep, you're a panelist. Okay, good. There you are. Next, go to back to the host tab. Okay, hold on a second. So you're a panelist now. And I gotta go back to the host tab, host tools. He will appear as a panelist. You're already there. Yeah. Click on his name, make him a co-host. How do I make you a co-host? And he will be able to talk and show his slides.
All right. How do we have to get the slides in somehow, I guess.
Yeah. Well, you're going to share your screen.
Right. But, how do I get them on my screen?
Well, you got to point, you got to go share down at the bottom.
Oh, okay.
You see where it says share.
Yep.
Um, let's see if you can get them up. He will appear as a panelist. You are in there as a panelist, so that's good. Click on his name, make him a co-host. Host me. How do I make him a co-host? Make co-host. Okay. Confirm. You are a co-host now.
Okay.
Then you will be able to talk and show your slides. So you should be able to talk and show your slides.
All right, now I got this. If the slides you sent me are in an email in Engage.
Right.
So
Can you pull them up?
let me see if I can.
Pull them up on
Uh,
your screen and then hit share at the bottom.
okay, hold on.
All right. I'm holding.
See if I can. Don't panic, Bill. Don't
I'm gonna
panic.
mute.
Um, okay. My problem is.
Oh crap.
All right, I have my slides on the screen. Can you see them?
Nope.
You cannot. All right, so I have to go down.
See the share button?
Yeah.
Hit that share button and then
All right, where is it? Come on, share.
it's down at the bottom. It's a little box with an arrow.
Yeah, I see it. I see it.
And then click on
Share.
your,
All right, and then share. All whiteboards, my whiteboards, no whiteboards. Templates. Ah,
I'm going to see if I can pull them up and then hit share. Oh, no participant.
I was concerned about this because I've never done this before.
I know it's not ideal. We should have done a practice run is what we should have done. But hold on a second. I don't even know if everybody's on mute. I've tried to put everybody on mute. So hold on one second. Let me just webinar information. Let me see if I can pull them. Um,
Can you see that?
yes, you got it.
Okay, so those are but they're not the ones that you sent me.
No, I've got it up too. Hold on one second.
Okay, and then we'd have to figure out a way to get rid of the border.
Hold on. Allow multiple, only one presenters can share at a time. Allow. Hold on a second. Let me see if I can pull up mine.
Okay, and then we'd have to figure out what I do
Can
with.
you see? Can you see mine?
I just see mine right now. It says
Okay.
yours. Should I stop share?
Stop share.
Yep.
Can you see mine?
No, I'm just seeing the score icon to the left and the William Mollica to the right.
Okay. They said that it's better if you share, not me. So, but hold on a second. You are screen sharing, it says. Well, meeting.
Well, I can get my slides up. I just want to get rid of the top border. I don't know how we do that. Slideshow. Maybe we do slideshow.
Yeah, you try on your end.
Yeah. Okay. Okay. Right now, I can see my screen. It's not, my slides are.
Good afternoon. Can everybody hear me?
Yes.
You can hear me, Bill, and what about everybody else?
I can hear you. Yes.
Okay, let's see if, yes. Okay, great. Okay, it's 12 on the dot, so we'll get started. Welcome, everybody. Welcome to Western Connecticut's SCORE webinar on liability insurance for your business, what you need to know. I'm Nadia Salgado Ariola, the webinar coordinator and a business mentor here at Western Connecticut SCORE, and I'll be your host. Please bear with us. Bill is new at doing a webinar with Western Connecticut, and I'm a new host. So please be patient with us as we try to get a little bit of the kinks out of this as we go. So our speaker is Bill Mollica, and I'm going to give you a little bit more information on him. But I first wanted to briefly go over SCORE in case there are any of you that are new to SCORE. SCORE is a SBA resource partner, a national nonprofit organization that was established by Congress in 1964. There are about 10,000 plus SCORE volunteers nationally in about 200 local chapters. Western Connecticut SCORE by itself has about 130 mentors with a wide range of industry, process, and subject matter expertise. Now we're called the Greater Western Connecticut, and we've got Litchfield County up at the top, all the way down to Lower Fairfield County. We offer three primary value-added services to small business owners. We offer free one-on-one counseling. You can either do it on email, video, or telephone. All you have to do is go into the SCORE website and ask for a mentor via the request mentor link on our website. We also provide educational in-person workshops and live webinars. And third, we have extensive resources on our website, including a network of subject matter experts at your disposal. So some quick housekeeping. If you have a question, please use the chat window at any time during the presentation. It's located in the lower part of your screen. And our workshop will end at 1 p.m. to respect your time. The session is being recorded, and the link to the recorded will be available within a couple of days. So now about our speaker. Bill Mollica is retired from a 29-year career as a large national and global commercial accounts insurance broker, where he excelled at creative problem solving and complex, comprehensive negotiation on behalf of his Fortune 500 clients. Bill also created and delivered several training programs for insurance professionals on workers' compensation, general liability, automobile liability, and excess umbrella liability. Therefore, he's a SCORE subject matter expert on insurance, a very, very important topic to small business owners. He is also a teacher, mentor, and coach, and a literacy volunteer doing individual tutoring and leading English as a second language conversation groups. So now I'll turn it over to Bill. Bill, it's all yours.
Thank you, Nadia. Hopefully everyone can hear me and see my first slide, the title slide. Liability insurance for your business, what you need to know. I'm going to go over a lot of things that are some of them concepts, some of them just things we need to do. So uh, today's topics. What is insurance, agents versus brokers, the marketplace, underwriting, coverages, liability claims, and hopefully some time for open discussion. About SCORE, we just got an introduction to that. Uh, I am selling 8 by 10s of my picture, but that's what I look like. What is insurance? Insurance is the mechanism that'll manage potential financial losses from unexpected events, and it's meant to financially provide financial stabilization to your business. Okay, it is not a profit-making scheme. Okay, agents versus brokers. Agents versus brokers. These would be the two people that would help you enter the insurance marketplace. However, they come from two different areas. An agent represents one or more insurance companies and acts as a direct link with the insurance company, and oftentimes has a limited amount of binding authority. A broker generally represents the client, not an insurance company, and advocates for the client, helping find the best coverage and price. That's your sort of your uncle in the business to help you shop and find a good deal. Brokers typically have no direct affiliation with a specific insurance company, whereas agents would be, for instance, a State Farm agent or a nationwide agent. Licensing. Both an agent and a broker are licensed. The insurance industry is a highly regulated industry. So an agent needs to be licensed to sell specific products for the insurers they represent. Their compensation is often through commission. So if you buy a policy from an agent that has $1,000 premium and it has a 10% commission, $100 would go to the agent and the $900 would go to the insurance company. A broker, they must have a broker's license, and their compensation is commissions are as well that are paid by the insurance company to the broker. And it works very much like it does with the agent. For very large accounts, insureds will often be on a fee basis that is negotiated up front. This is a copy of a certificate of insurance. This is the industry standard for representing to outside parties what insurances you currently have in effect. It's a very important piece of paper. The source of it would be your agent or your broker. It basically lists your coverages and your limits and your policy number and effective dates and insurance companies. It does not reveal your premium. It does not do that. Certificates of insurance is usually a major source of service from either your agent or your broker, meaning that oftentimes your landlord will want to see it, and perhaps some of your larger clients will want to see your proof of insurance. And sometimes they want to see it right away. I used to have a trucking client, and one time I got a phone call from a truck driver. He was stopped at a client's gate, at his customer's gate, and for a certificate of insurance, proof of insurance, and we had to get it to them right away. Um, so, agents versus brokers, how do I choose one? What do I need for my business? How do you choose one? Well, I would say when it comes to either one, if you have a friend that's in business, maybe ask them if they're happy with their agent or broker. You can certainly go by brand names. Brand names in the brokerage industry include Marsh USA, Aon, Willis, Epic, other ones as well. What do I need in terms of what you need for your business? Your agent or broker should be the one that tells you. They're your guide. They're your advisor. The insurance marketplace. So the insurance marketplace has two kind of designations, admitted and non-admitted. Admitted basically means it must be licensed by each state. The insurance company must be licensed in each state to do business in that state. And they offer usually standardized policies, and they also offer an additional protection called the state guarantee fund up to certain limits, meaning if your insurance company goes bankrupt and the money's not there to pay your claim, the state has a fund that could possibly step in to pay your claim. Not admitted, not licensed, but still needs to be authorized to provide insurance in the states. They don't have any state guarantee fund, but they do have flexibility. They're not required to file rates and forms with the state, and it allows for these companies to do manuscript policies, which are customized policies, almost written from scratch to ensure your specific risk. And in terms of market focus, an admitted company typically does common and straightforward risks. One might call it Main Street. And then the non-admitted, they specialize in covering risks that admitted insurers avoid. For instance, Lloyd's of London. We've all heard stories about Lloyd's of London, insuring somebody's legs or arms or hand because they're a pianist or whatever. So, like that. The insurance marketplace. Insurance companies are rated for their financial strength and their own stability. And the source for knowing what your insurance company's rating is probably would be the internet or your agent and broker. So rating agencies include AM Best, Standard and Poor's, Moody's, and the rating scales such as AM Best might have A++, superior, excellent, good, poor, weak. As a matter of fact, my firm that I'm retired from, Marsh USA, we were not allowed to place any customer's business with an insurance company that had a rating of less than, I believe, A or A plus. Okay, so this slide is meant to represent the insurance reinsurance matrix. Insurance companies buy insurance on their risks. So if we look at this chart, you are at the top, and your prospective insurers, Travelers, the Hartford, State Farm, is there. So you go to them and buy a policy from them. They will reinsure it out to other reinsurance companies like Munich Re, Swiss Re, Lloyd's, Berkshire Hathaway. What are they doing? They're spreading the risk. And by so doing, they are now putting your risk into the global reinsurance marketplace. So, really quick example. If if you have a policy with Travelers, your policy premium is $1,000. The Travelers decides to reinsure basically 50% of that. So they will send 50% of premium to, let's say, Swiss Re. And now Swiss Re will be responsible for 50% of any loss that comes onto your policy. So Travelers would pay 50%, and the reinsurer will pay Travelers to pay the balance of the 100%. Reinsurance is why the tsunami in Japan could possibly affect what you pay for insurance. Because if these reinsurers are having a bad year from a lot of losses or from big losses, they're going to need to pass on that those losses on to customers. So that's how the wildfires in Los Angeles and floods around the globe are possibly affecting what you pay for your insurance. The underwriting process. How do I create my submission? How detailed and accurate should it be? And when should I inform my insurer of changes? How detailed and accurate should it be? As detailed and accurate as possible. If you misrepresent your information to the insurance company, you could be jeopardizing coverage and prejudice the policy. When should I inform my insurer of changes? Uh, I would say immediately or very soon when it happens, and I'll let the insurance company decide if they need to do anything with that. And how do I create my submission? Your agent and or broker will guide you through that. So the underwriting process would start with an application or a submission. An application is basically a questionnaire that you would answer, and it involves questions about your business and about what you're seeking insurance for. So, therefore, if you are seeking workers' compensation insurance, it's going to ask you about your what your employees are doing and all and that kind of thing. We're going to go into that more later in this presentation. So, your application or submission gets viewed and evaluated by the underwriter, and they do a risk assessment, data collection and verification. For instance, how many employees, that kind of thing. Then they classify the risk, and then they do a premium determination. So either there is a policy approval or declination. And if they approve and decide they want to write your business, they will give you a proposal or a quote. And if they decide they do not want to write your business, they will decline the quote or they will decline the business. The underwriting process often includes retentions, either as a deductible or a self-insured retention, SIR. And this is a graph that basically shows you the difference between the two. Sometimes people will use the word deductible and SIR interchangeably, but technically they are different. So a deductible is where you would the insurance company would pay the claim in totality, and then you would reimburse them for the deductible amount. And then a self-insured retention is the policy does not respond until you have paid your portion or the self-insured retention. You pay first. Okay, so application and submission. Basically, it's a method insurers use to assess the risks associated with insuring a person, business, or property. The application and the submission. The application process begins with the applicant creating and submitting an insurance application, and it includes personal or business information details about the business, operations, and or property to be insured, and any relevant risk factors. And we'll be getting into those as well. Um, risk assessment. In terms of your workforce, their age, their health, the occupation, driving history, credit score. Occupation would be comp, driving history would be auto liability, and the credit score would basically be for maybe general liability. If it's a property risk, they're going to want to know your location and condition. So we use COPE, construction. Is it wood, brick, cinder block? Occupancy, who's in the building with you? Do you have a fireworks manufacturer along with you, or do you have just a floral shop next to you? Protection, is it sprinklered? And is there other protections involved? Is the building fire resistant? And exposure, what is around you? Is that dynamite factory, within 100 yards of you? Is the chemical plant within half a mile of you? So that's the kinds of things they're looking for. And of course, what business you're in, the industry, your size, the operations, your claims history, very important because underwriters use past claims history to assess and determine what they feel the future will be. Safety programs, management attitude, corporate culture. Those things are very important in larger corporations, but when you're just starting out, you still have a management attitude. Do you care about your workers? Do you care about your premises? Are they clean? Are they safe? Data collection and verification. Underwriters use various tools. There's a lot of information out there on the internet. Number one, claims loss history. That is primarily what underwriters use to determine how they're going to either take your risk and price it or not. So you're going to need to have accurate loss information. Where does that come from? It comes from your current and past insurance companies, and your agent and broker can help you with that. Inspection reports. Did insurance companies come out and take a look at your premises and your operations? And did they make recommendations? And are those recommendations big, important, or are they just small little things like clean up the rags in the corner? Credit history, actuarial data and statistics, and then industry databases. They'll compare you against other companies in your industry. Risk classification. You could be either a preferred risk, which means low risk and good loss history, standard risk, where you're average and you pay standard premiums and have a typical loss experience. Typical meaning what you would expect for a company like yours, just to open up your doors and operate your business. And then there's substandard risk. Okay. Higher risk applicants who may face higher premiums or policy exclusions and typically experience higher or more severe losses. And then premium determination, the underwriter calculates the premium by some of these factors: type of coverage, whether it's workers' comp, general liability, auto liability. How much limit do you want? Do you want $1 million, 2 million, 500,000? How much are you willing to take in retention or deductible? Generally speaking, the more you're willing to retain, the higher your deductible or retention. It should have an effect of reducing the premium. Regulatory requirements, if any, and then market competition. Okay. Um, whether they are market correct in terms of pricing, what are other insurance companies offering? That's something that your agent and or broker, especially your broker, will kind of be controlling and monitoring. So, policy approval or rejection based on the underwriter's evaluation. The underwriter decides to approve the application and issue a policy as quoted, to approve with modifications such as higher premiums, exclusions, higher retentions, or lower coverage limits, or reject or decline the submission, and thus not offer any quote. Now, the process is basically you submit, the underwriter will basically release a proposal. It wouldn't automatically bind you into coverage, but would offer a proposal or a quote, and then you and your agent and your broker and or broker would evaluate each one of those proposals, compare and contrast, and decide which one you want to go. Um, you typically do not engage an agent and a broker. You either deal with the State Farm agent for your insurance needs, or you deal with your XYZ broker and allow them to handle it. It's really not good form to have two brokers or three brokers handling all of and handling your business, because the marketplace doesn't like it when there's three different parties involved. Okay.
Bill, it's
Y-
Nadia. If I may stop you for a
Yep, I know I'm going pretty fast, so
yeah, and I have a question in the chat from a gentleman, if I may ask it.
yes, please.
So the question is, how do insurance companies assess rates if this is a startup business with no loss history?
Okay. They would do it based on other data, and it would probably be based on your industry and what you do. If you're operating a business that, generically speaking, you're not going to harm your employees, or you're not dealing with something that might be poisonous or hazardous, like you're a fertilizer dealer. They're going to do it by the industry, and they're going to do it by where you are located, that kind of thing. And they're going to do it by the answers they get on their application. So if you submit an application and you tell them that you do not, that the building that you're in is not sprinklered, well, that's going to make you possibly a high risk property risk, that kind of thing.
So you're saying
Hopefully,
they would go by industry information.
yes,
There's
by
no
industry, yeah,
history.
by industry history,
Mhm.
the underwriters have a lot of data. And so what they'll do is they'll investigate and research what insurance losses are like in your industry. And then they will compare it to your size of operations. If you're just starting out, you're a one person, two-person operation, and you hope to only do maybe $100,000 in sales, they'll take that into consideration. But
Okay.
if you're a larger business and you're going to have maybe 500,000 or a million in sales, they take that into consideration too, because the scale is larger.
Okay, I have another question, if I may.
Yes.
If I can't work with more than one broker, then how do I know I am getting the service and pricing that is right for me?
Okay, that's a good question. The broker, it's the answer to that is hopefully you can get a referral from a trusted friend who's in business and has had experience with the broker. Short of that, I would say to you, do a little bit of an interview. You make a list of brokers that you want to possibly approach, call them and see how you're treated. See if they're responsive. See if they answer your questions, and see what kind of vibe you get from them. I mean, some of the companies I mentioned, they're very large, and their reputation is based on years and years and years of being in the giant, client insurance industry. But that's kind of the way you would do it. You might also ask questions about, you would ask questions like, do you do you do you have many clients in my industry? Yes or no? Do you have many clients that do what I do? Yes or no? That kind of thing. Try and make it very specific as to what you're maybe concerned about. Hey, I think I'm going to need a lot of certificates of insurance. Tell me how quickly I can get them and how do I get them distributed? That kind of thing.
So a follow-up question, Bill. Is there a directory of insurance brokers or is it just a Google search?
It's just a Google search. I mean, is there a directory of brokers? Probably, but that would be like just going to the yellow pages. So I would say do a Google search or maybe go to Chat GPT, type in um, maybe what are the best rated insurance brokers servicing Fairfield County, Connecticut, and see what comes up.
Okay. Another question for you.
Yep.
I'm building an internet startup, and I expect the terms of service would substantially increase or reduce the risk. Do insurance agencies review these, or do they have templates for certain kinds of
Okay. I'm making this distinction between services and coverages. Okay. Coverage and services are different. So if you have specific service needs based on what you're doing, those are the questions you ask that broker or agent about how they could respond to it. Just like you would call up somebody to put a roof on your house. You'd talk to them and you say, okay, what roofing material would you use? Do you warranty your work? That kind of thing. In terms of coverage is a little bit more standardized, and we'll get more into that later in the program.
Okay, thank you. I don't have anything come up yet, so I'll let you know.
Okay. Well, when you do, just do just like you did now. It'd be great.
Okay.
Um, all right. So most of you, if you're just starting up, one person, two person, three person, you're in infancy. The coverage you're going to be looking for is called a business owner's policy, or BOP. And a business owner's policy bundles several core coverages, and it's designed for small to mid-sized businesses. Okay. As you probably know from other parts of your life when you buy things, when you bundle something, or when you buy, for instance, when you buy your home and auto together, you get a price reduction kind of a thing. Same thing here with the BOP policy. So on the BOP policy, you have general liability insurance, and it protects your business from bodily injury to a third party. Customer slips and falls on your premises. Okay? Not to you, to a third party not affiliated with your business. Property damage to someone else's property, again, third party. Personal and advertising injury, libel, slander, copyright claims, and ads. And this last one, which probably should be first, but I put it last for the grand finale, legal defense costs and settlements. In liability insurance, oftentimes the legal expenses to when it comes to a suit might even exceed the actual settlement. You go to court and your lawyers do a good job and they defend you and you pay nothing, but you've got legal expenses of $100,000. So the legal defense costs are essentially unlimited on a general liability policy. This is a major uh, advantage to a general liability policy. And here's the rub: general liability policy is not required by law. You can choose to not buy a general liability policy, which would be, excuse my brusqueness, stupid. You could choose not to buy a general liability policy and go what's called bare, or without insurance, or uninsured. It is not recommended. Okay. Also in the BOP policy is property insurance. So it covers your business property, which is first party insurance. First party means insurance company and you, versus third party, which means insurance company, you, claimant. So your building, if you own or lease it, office equipment, inventory, furniture, and fixtures. That's part of your property coverage. Okay? And it's protected against events like fire, theft, vandalism, and certain weather events depending on policy. All risk policy is preferred. Okay. You really must be insistent on getting an all risk property policy. Why do I say that? Because, as you know, with certain weather events, sometimes you may have heard stories in the news about the insurance company denying coverage because, well, that damage was done by water from a flood. they don't have flood coverage, so we're not going to pay anything. Or that damage was done by wind, and they don't have wind coverage, so we're not going to pay anything. So that's the way it works. It's called a named perils policy, and you really don't want to go through that. It'll be like the scarecrow in the Wizard of Oz when he has both his arms up pointing in opposite directions. Nobody wants to pay the claim because they feel it's some other peril that caused it. Okay? So you want all risk property. And then it includes business interruption insurance, or also called business income insurance. So if your business must temporarily close due to a covered loss, like a fire, this can pay for lost income, your rent or mortgage payments that need to keep going while you're out of operation, payroll in some cases, and operating expenses. Expenses you incur above and beyond usual to keep your business going. For instance, renting a storefront someplace else, that kind of thing. Okay. So you're just starting out. You basically want to have a BOP policy. Simple summary: think of a BOP policy as property protection, liability protection, income protection, all bundled into one policy. And they are typically, and they're priced accordingly, meaning they're priced for startups. They're not, they shouldn't be overly expensive, but these days I'm not quite sure. Workers' compensation. All right.
Bill, if I may interrupt for another question.
Yes, go right ahead.
This gentleman says, I'm a management consultant with a master service agreement in front of a Fortune 500 company. What kind of coverage do you recommend? I have a home umbrella policy.
That's it. If I'm understanding what he's doing, um, he's woefully underinsured. I don't know, is he an LLC? Because if he's not protected by being an LLC, he's really rolling the dice, in my opinion. And I'll get to that more later on when we talk about professional liability insurance. Okay? And
Okay,
if
he is an LLC, by the way.
Oh, okay. That's okay, good. Whew. All right, good. All right, so let's move on to comp. I will cover that more with professional liability later on. Workers' compensation. Who needs it? If you are an employer with one or more employees, full or part-time, doesn't matter, you must provide workers' compensation insurance. And a little quiz I used to give my students when I was working and when I was training them, I'd say, who does a workers' compensation policy cover? And they'd all say, oh, the employees when they get hurt, blah, blah. The answer is no. The workers' compensation policy covers the employer in that it provides them the coverage required by law. Okay. Yes, the coverage includes paying for injuries to employees. However, it's really covering that workers' compensation and fulfilling their legal obligation to provide workers' compensation. If you're a sole proprietor, partner member of an LLC are generally not required to cover themselves but can choose to be included. Independent contractors are not covered unless they meet criteria that classify them as employees under Connecticut law. I don't know about those Connecticut laws. Sorry. What does workers' compensation cover? So, top of the line, the employer's compliance with the state's workers' comp laws. Now, keep in mind, every one of our 50 states has their own set of workers' compensation laws and a workers' compensation policy whereby you name the state you're operating would cover the requirement in any state that you're doing business or operating. Okay? Medical treatment for workplace injuries or illnesses, lost wages, unable to work during their injury, rehabilitation costs to help employees return to work, compensation for permanent disability or death. Okay? Workers' compensation is purchased through brokers and agents, and you can get it from the Connecticut Workers' Compensation Insurance Plan. It's called Assigned Risk, which provides coverage for high risk employers unable to find insurance in the standard marketplace because their losses are so high. Okay, and those are generally businesses that aren't paying attention to worker safety, and they're not keeping a tidy house. They're not being keeping a safe house. You do not want to be in that workers' compensation insurance plan. It's like being in purgatory or hell because your premiums will be high, and you'll have a hard time getting out of there uh, based on your past, losses. It's designed to cover medical coverage, doctor's visits, hospital stays, surgery, all those things, wage replacement, disability benefits. Really quickly, workers' compensation is highly regulated, and there's four types of benefits: temporary total disability, so temporary total disability, temporary partial disability. So temporary total disability might be a broken left arm. That left arm is totally disabled temporarily until it heals. Temporary partial disability, might be that you can still use the wrist or something like that, and will be healed in 100% in due time. And permanent is just that: permanent total disability, not to be gross, but the left arm is no longer there. They lost the left arm. And then permanent partial, they didn't lose the whole arm, but they did lose the use of their thumb on their left hand or whatever. Sounds a little bit macabre, but that's the way it is. Rehabilitation costs, retraining, skills development, counseling, death benefits, a lump sum payment or weekly benefits to the surviving spouse or dependents, funeral and burial costs. Limits vary by state. Now, let me say this: injuries and what an insurance company will pay in workers' compensation benefits is scheduled by the type of injury. Sounds a little weird, right? So if you lose a thumb in Alabama, that might be, you may get a benefit of $300. If you lose that same thumb in New York, you might have a benefit of $1,500. Why is that? It's all about, the cost of living. It's all about where the jurisdiction that the claim happened. And it's like that throughout the entire 50 states. These injuries are scheduled and have a specific dollar amount. Employer liability protects the employer from lawsuits if an employee decides to sue and the injury is excluded under workers' comp law, or the employer is alleged to have been negligent in providing a safe work environment. So understand that these workers' compensation benefits are not going to get you on a luxury cruise in the Bahamas kind of thing. They are basic, meet the needs kind of benefits, and if for instance for pay, you get injured, you can't work for the rest of your life. Well, the benefits that they're going to pay you for the rest of your life maybe is $400 a week, and you can't live on $400 a week. And the accident happened because your employer didn't have certain protections on their machinery. So there's no way you're going to survive on $400 a week for the rest of your life. So you may have no choice but to sue your employer for negligence to get a higher amount so that you can support yourself for the rest of your life. Coverage for occupational illnesses, respiratory, repetitive stress injuries, hearing loss, illness and or injury from chemical exposure. Okay? Exclusions in a workers' comp policy. Is the injury compensable? Is it covered by the workers' compensation policy and the laws and benefits in that state? So, injuries caused by employee intoxication or drug use, not covered. Self-inflicted injury, not covered. Injuries, illegal activities, no. Injuries that occur while violating company policies, no. Any questions?
Yes, Bill, I was just going to interrupt you, so it was perfect. Um, yeah, let me just get to a couple of questions because we're getting a little closer to the end of the hour. So, first question, how this is going back to the BOP or the general liability.
Mhm.
How do I determine to go with a general liability policy or BOP?
Well, a BOP policy will have general liability in it, along with
Okay.
property and um, the other coverage of business interruption.
Okay. And then another question. At what point do I need workers' comp insurance?
When you have one or more full-time employee or part-time employee.
That's all I have for now.
Okay, good, because it's going to be close. Commercial general liability. We talked a little bit about this. This is for third injuries to third party, bodily injury, or property damage. Notice I did not say financial loss. It's for personal bodily injury or property damage to a third party. By financial loss, I mean, hey, your product didn't work the way it was supposed to, and I lost $1 million in sales. No, not covered by the GL policy. However, I used your product the way it was intended to be used. I followed the owner's manual, and I lost a finger. The general liability policy will cover that. That's bodily injury to a third party. Same thing when it comes to property damage. If the operations of your business cause a property damage to a third party, the general liability policy will cover it. So, general liability policies typically cover products and completed operations coverage, which is like I say, you sell a widget, and the widget goes out into the marketplace or it goes out into the world, and it injures somebody when it's being used the way it should be. The product's liability coverage will handle it. If you're a contractor and you go do a job and you complete the job and your work injures somebody, um, and the completed operations portion of the policy will cover it. Excuse me. Personal and advertising injury covers non-physical injuries caused by business, such as defamation, libel, or whatever. Tenant's legal liability. If you are renting premises, more than likely your landlord is going to want you to have insurance and they're going to want you to have tenant's legal liability. So if you have a general liability policy, which you should, then tenant's liability would be covered in there. Medical payments covers immediate medical expenses for injuries sustained by third parties on the business premises or due to its operation, regardless of fault. Again, I can't emphasize this enough. You get legal defense costs are covered, often in addition to policy limits. So you might have $1 million general liability policy limit, and you might end up spending, it might be $200,000, $300,000 in defense. That $300,000 does not deplete the policy limit. Additional coverages, liquor liability, if you're a bar, tavern, liquor store, employee benefits liability, protects against cyber attacks and such possibly, and contractual liability covers liability assumed under certain business contracts like leases. And what the CGL policy typically does not cover is covered elsewhere. Automobile liability.
Bill, if I may stop you for a second, I
Yep.
have another question. I just trying to get as many in as I can.
Okay.
A gentleman says, does the insurance, gentleman or lady, does the insurance broker review the terms and conditions and exclusions with the client before the policy is purchased?
Yes.
And who does this? A lawyer?
No. The insurance broker. The insurance broker, if the client says, I'd like you to explain these coverages to me. I'd like you to explain this proposal. These are my questions. That is the job of the insurance broker.
Okay, thank you.
Okay. Business auto, again, bodily injury and property damage caused by vehicles used for your business operations. The vehicles that you are operating, if they cause bodily injury or property damage to a third party, this policy will cover it. The minimum liability limits in Connecticut for all vehicles as of 2025 was 25,000, 50,000, 25,000. Too little. You can't do nothing with 25,000 these days. And your policy should be typically $1 million at least $1 million. Okay. And this has nothing to do whether you operate one vehicle or 100 vehicles. If you operate one vehicle or you're asking employees to use their personal auto, you need to have a business auto liability policy. Now, the business auto liability policy covers liability, third party, and also covers physical damage, which is first party. In other words, it's coverage for protection of your vehicle, collision, when for damages caused by collisions, or comprehensive covers your vehicle for things like theft, fire, or vandalism to your vehicle. Uninsured, underinsured motorist coverage. It's when your policy protects you when the person at fault has no or too little insurance. And I personally have a story of that where my wife got into an accident and the other guy had minimal Connecticut insurance, $25,000, whatever it was. My policy ended up paying for the whole situation. Hired and non-owned auto insurance, vehicles not owned by the business but used for business purposes, employee-owned vehicles, or rental cars. So even though you don't own any vehicles, if you send an employee out to Sheboygan to see a client and they rent a car, this policy would offer coverage if, as long as they do a rental contract. Medical payments coverage, okay. And then optional coverages, roadside assistance, rental reimbursement, gap insurance, very quickly. This is insurance that'll pay the difference between the vehicle's actual cash value and the amount owned on the vehicle or loan. So if you're leasing your vehicles, you should have gap insurance. Who needs business auto insurance? If you own, lease, or rent vehicles, and companies with employees who drive their personal vehicles for business purposes. Requirements and regulations. You must have auto insurance in the state of Connecticut. Okay.
Bill, quickly before you move on to
Yep.
your next thing, let me just grab this question. This person said, I have a $1.5 million coverage for my business automobile. Do you need to list the employees that will be using the vehicle for business?
Um, okay. They do not have to appear on the policy, but the underwriting process will call for you to submit a list of drivers, their name, their driver's license number, and all certain details, because what they will do is they will look up their driving records.
Okay. I have another question regarding coverage needs. Can a broker reliably advise on what specific coverage we need based on services provided? Or should we consult an attorney first to map that out?
Okay, again, coverage and services are two different things. Okay, so let me see if I can give an example. Okay, so
Well,
um,
based on let's just say it's based on the services, the businesses. The way I'm reading it is the way the services the business is providing.
okay, yeah. So
Well,
the
a cleaning
service,
company, for example.
right? So whatever your company is providing, the business that you are in, the broker should be competent enough and capable enough to tell you what kind of coverages you need. Okay. Keep in mind that the coverages are not um, if you get a general liability policy and you're a widget manufacturer, you've got coverage. So the coverages don't really necessarily get restricted by what you do. If an underwriter accepts quotes your business and accepts your risk and issues a policy, that policy covers your operations.
Okay, thank you.
Okay? Okay. Excess liability, I'm going to go rather quickly. These are additional limits. You buy these limits, they sit on top of your primary layer, the layer, that you buy first and that responds first to a loss. Um, you can get $1 million, 5 million, 10 million, whatever you really want is doable. And what determines if you need more limits? Basically, the size and scope of your business. Okay. If you have a business that's taking in $5 million in revenue a year, and you've got a lot of assets and stuff to protect, and what you do could possibly generate a large claim, then you want to get excess liability limits. Okay. Umbrella versus excess, very quickly, an umbrella policy, like the name says, will cover you for more limits and possibly for more coverage than you have on that primary layer. Excess will provide you more limits, but will only cover you for the coverages that you have below it in the primary layer. So it's called follow form. It follows the form beneath them. And then excess liability coverage, you must have primary limits below you that are not exhausted. And because once it's depleted, the excess liability policy is triggered. At a certain attachment point, your excess liability may not trigger or become effective until your losses below maybe equal $1 million. And then there may be requirements for your underlying policies, which means specific limits. In other words, you won't get an excess liability policy attaching at $100,000. You might get it attaching at a million or 2 million. Okay. Professional liability. I said I was going to get to this. These are coverages for when you provide a service, expertise, advice. You're an accountant. You're architect, whatever. Okay. This is coverage for errors and omissions, and this does protect against financial loss due to negligence, errors and omissions, and our failure to deliver services as promised. Okay. It's industry specific. Most professional liabilities policies are written on a claims made policy. And I'm going to skip over this because we don't have the time. But there's two types of policy: occurrence and claims made. Occurrence triggers coverage when the event happens in the policy period, regardless of when a claim comes in. If you have an occurrence that creates claims in 2006 and a person gets injured in that event, and 2 years from now they make a claim, you're covered by that policy. Claims made, not necessarily the same. Claims made, you have to have the claim come within a policy period that's active. So if you don't buy what's called an extended reporting period, or if you don't continue if you don't renew with the same insurer year after year, you will lose the ability to have a claim paid after a certain amount of time. Okay, and this claim occurrence versus claims made, is its own webinar, its own class. So I'm going to go right by this. Third-party financial losses, defense costs. There are companies that feel as if they're never going to have a claim. Let's say directors and officers, but they buy a policy anyway to defend themselves. So the directors and officers liability policy protects against claims from your shareholders. Well, if a shareholder files a frivolous suit and you know it's not going to pay out, you still have to defend it. A directors and officers professional liability policy will provide you defense costs, and that's why some companies bother to even buy it, is for the defense costs. Okay. And okay. Liability
So, Bill,
claims.
if I may,
Yep. Yep.
we're
Go
five
ahead.
minutes out from the hour.
Yep.
I have one final question here. Do excess or umbrella policies cover professional liability?
Yes, they can.
Okay.
Keep in mind that there are insurance companies and insurance underwriters and insurance policy forms that are specific to a lot of these coverages. For instance, a professional liability or directors and officers liability underwriter, that is a specialty, that is a silo in the industry. Okay. So someone who's writing comp and general liability is probably not an underwriter for directors and officers liability. Liability claims, as quickly as I can. there's a whole lot of things that go into claims and liability claims. You know, what your loss trend is, what your exposure is. You know, have you increased your autos from 100 to 1,000? How severe are your claims? Do you have a lot of little claims, which would be a frequency trend, or do you have just a few big claims? Okay. And then development, what happens is underwriters look at the current data and they develop it. They apply loss development factors that are sourced by actuaries, and it's kind of a educated actuarial guesstimate as to what your losses currently might uh, be in the future, meaning how much you might have to pay in the future. And this is to ensure that the insurance companies have adequate reserves and therefore can quote an accurate premium so don't underprice and overprice. And then the claim resolution would be denial of the claim. Settlement is an agreement between the insurer and claimant to resolve, settle, and close the claim, or a court judgment, the verdict by a judge or jury if the claim proceeds to litigation or trial. Insurance companies typically don't want to go to a jury because juries get very sympathetic, and sometimes in some areas of the country, they look at an insurance claim as social welfare. Okay. Open discussion, questions. Sorry I had to go so fast and I had to skip over some things. It's the first, this was a 90-minute presentation that I had to cut down to 60 minutes and I didn't cut enough.
Thank you so much, Bill. I know it's a lot of information, and a very complicated topic. We only have a couple of minutes left. So thank you so much. As a reminder, a recording of this webinar and any materials will be available within a couple of days on the website. So please check it. Just a quick reminder, SCORE offers free individual counseling. So you may use the link on the screen or visit our website and click Request a Mentor. If you want some specific advice or mentoring on insurance, or you want to request uh, any kind of insurance topic, just put that on your request, and a mentor will be assigned. Um,
Probably me.
I was gonna say, maybe Bill, you can always request them. Please fill out your evaluations that will be sent at the end of the webinar. On behalf of SCORE, I'd like to thank you all for attending today's live webinar. In closing, a big thank you to Bill for presenting today and have a great day. Everybody, let me just check real quick before we log off if there's any other questions. No. So everything, the slides and the webinar should be available within 48 hours. Thank you so much.
Nadia? Nadia?